Welcome everybody. My name is Michael Rundis and I'm EY's Oceania. There goes your clicker, Paul. EY Oceania's Mining and Metals Leader. I'll be your host today, and it gives me great pleasure to be launching our 2025 Global Business Risks and Opportunities in Mining and Metals report from here in Perth, my hometown, and the home to many national mining and international mining companies. And it's great to see so many clients and colleagues here in the room and also online through the webcast, so welcome. I first want to begin by acknowledging the traditional owners of the land on which we meet, the Whadjuk people of the Noongar Nation, and pay my respects to elders past, present and emerging. I also want to acknowledge the important role that Aboriginal and Torres Strait Islanders play in the communities in which we live and work. Now, in Noongar culture, we have 6 seasons, and those 6 seasons accurately represent what's happening on the land, the waterways, and in the skies. And as we transition from the wet season through Julbar, which we've just completed, we've seen the cooler nights, the clear skies, and also you would have noticed a flurry of red and pink flowers out there on the land. And as we move into Camberang, we'll see more animal activity, we'll see the return of the reptiles, and we'll also see a big flowering of the yellow flowers. And those yellow flowers signify that heat is coming and the hotter days are ahead. And I was reflecting on the environment and the fact that it's always in a state of transition. And in a similar way, our mining industry is always in a state of transition. Currently, we're at the front end of the energy transition, and we've seen a significant change in society's expectation or understanding of the role that the mining industry will play in the energy transition. And we will need more access to resources over the coming decades to make that transition and decarbonisation happen. We've also seen a significant change in societal expectation around all things environment, social and governance, and in particular this year around environment and biodiversity and water. But my role today is not to give you some of the sneak peeks from the survey. It's actually to introduce our guests, and it gives me great pleasure to welcome Paul Mitchell, who is our Global Mining and Metals Leader. Paul is going to come to the stage in a minute and give us a 15-minute overview of the paper and talk to the key points therein. Paul he's got 10 years of operational mining experience and 20 years of consulting experience, and he works with our largest mining clients on their most complex issues. Paul's also a member of the board member of the Colorado School of Mines and BRIM as well, and also the author of the paper. And we have assembled for you today a fantastic panel, and I'm really looking forward to Paul hosting that panel conversation. We've got Sandy Sibenaler. Sandy's the CFO of South32, responsible for a diverse portfolio of financial management reporting, treasury, tax, business evaluation, investor relations, and group assurance. Sandy's got more than 20 years' experience in the resources sector with Woodside, BHP, and now South32. We've also got Simon Richmond. Simon's Rio Tinto Iron Ore's CFO and responsible for the finance function, business partners, business analysis, digital improvement, joint ventures, and strategy. Prior to this role, Simon was also the Chief Procurement Officer for Rio Tinto, and he's had many roles within product groups and across lots of different countries. So in his 20 years with Rio Tinto. So thank you, Simon. And we've also got Adrienne LaBombard, is on our leadership team of the Chamber of Minerals and Energy in Western Australia. And this is a peak resources sector representative body. Adrienne is responsible for leading the development of the Chamber's policy positions and guiding the delivery of the Chamber's policy and advocacy strategy. She's passionate about the role of industry associations in forming policy development, and works closely with members, government and other stakeholders across a diverse range of areas in the Western Australian resources sector. Welcome. So thank you for joining the panel, and I'll hand over to Paul to take us through the report.
Thanks, Mike, and hi everyone. It's great to be back in Perth. It's been a few years since we've launched the risk report here in Perth, so excellent to be back. It's sort of everywhere we go with this report and everywhere we go in the industry, you get a mixed reaction when you say you're from the mining industry. But in Perth, it's always positive, and it's always great to sort of feel that buzz, feel the energy, particularly when the iron ore price is up a little bit. The mood always improves, and I think it's great to be doing that here today. So thank you. It's good to be back. Look, I always start, I don't sort of jump straight into the report. I always start with a little bit of a state of the nation and sort of talk about where the industry is. Mike talked about the fact that we're at the start of the energy transition. And I think we're seeing that investment and that demand for minerals that's coming from the energy transition driving a lot of what's happening in our industry. Unprecedented demand for a range of minerals. And you'll notice I don't use the word critical minerals. I've banned that from my team. I'd like to be able to ban it from the media, but I don't think we'll get there. Critical minerals include iron ore and, despite the fact that people don't like us to say it, it includes metallurgical coal. Infrastructure is a huge part of the energy transition. And I think we're seeing that at the moment, that demand for minerals is starting with infrastructure. And that's one of the reasons that despite China's difficulties in terms of economic progress, we're seeing the demand for iron ore and met coal remain really strong in terms of what's there. That'll move on to copper. We've seen the copper price go up this year. That'll move on to copper. We'll see copper finally break $10,000 a tonne. We are waiting for that day. And I think you'll see it go further in terms of what's there. And then we will see the recovery of things like nickel, things like lithium. Those mines will reopen. The state will be good in terms of what's there. But there is not enough capital in the globe to open all of those mines and operate all of those mines at one point in time, particularly when a huge amount of that capital is being diverted to building renewable energy, building infrastructure, and doing the other things that have to happen in the world, good and bad at the moment in terms of what we're seeing. So I like to think that we're sitting at a point where the future outlook for our industry looks great. Now, as I often say to people, I'm here doing a presentation at 6 o'clock at night. I'm not sitting on my island drinking cocktails. So my ability as a commodity price forecaster is iffy at best. But things look good for the next 5 to 10 years. When you look at those shortages, when you look at the demands that have to happen, we have to open a bunch of new mines and we have to do some different things in terms of what's there. So we look forward to doing that and continuing success for our industry. We have seen, though, that there's a lot of headwinds in terms of what's there. So for the last 3 years, the top risk has been ESG. And I think that's reflected the fact that expectations of us as an industry have changed. Perhaps that we've been a little bit slow in recognising that. I think we are on the case now. I think there's some fantastic progress being made. But we don't always meet the commitments that we have to do as a global industry around the world. Now, the big operators, the good operators, they certainly do in terms of what's there. But there are practices around our industry that need to change in terms of what's there. And I think all of us have a role in encouraging that. Because we need to build that brand and make sure that everyone realises that not just the energy transition is dependent on this industry, our way of life and what we have at the moment is dependent on this industry. We wouldn't be meeting on the 5th floor. We wouldn't be doing a webcast for the world. We wouldn't be doing any of those things, and we probably wouldn't have enough food to feed us without the mining industry. I think the more we can tell that story, the better, because we need to get that message out and about. If we get that out, we'll have the money to raise the mines, and we'll all have successful careers. Me for maybe the next 5 or 10 years, some of you for a bit longer than that in terms of where we're going. So I look forward to that as we go. So this is the 17th year we've run the survey. And when you look back over the results of the survey, you see some really interesting trends start to emerge. So what we do is we survey a reasonably similar group of people. It tends to be the C-suite or the boards of operating mining companies. So it's not explorers, it's not the small end of the market, it's the big end of the market. And it's really global in terms of what we do. So right across the key mining regions. So, think Canada, think Chile, think Brazil, think South Africa, lots in London, just given the legacy of where capital comes from and those sort of things. We do have a little bit of a gap in China, but we've got a few people that do it there. And a number of the trading companies from Japan also participate in terms of what we do. So it is really nice and global. I was saying to some people earlier today, you can sort of tell where people come from depending on their answers. Now, if they say water's the number one issue, pretty much guarantee they're from Chile. in terms of what's there. And you can really pick out those issues as you go on. But I think it gives us an interesting perspective to understand what's there. We also ask them to think forward when they're answering the questions. So what's going to come next year? What is this going to look like in the future? How do you reflect on it? And I think they generally do a pretty good job of that. We're only asking them to think a year forward. It's not complex in terms of what's there, but they do think about that as they sort of move forward. If I look at our risks this year, a lot of them are thinking about what are the issues that are going to stop us having the opportunities that we know are ahead of us. So they tend to be longer term, time-based issues in terms of what's there. Costs and productivity is on there still. That's still the operational one. As some of you know, that did fall off one year, but I put it back in because you absolutely have to have that risk on there. It's not a mining survey if you don't realise that you've got to reduce your costs, is the message I give to all people. But this year we're seeing those longer term, we're seeing things looking out, and we're seeing those strategic issues in terms of what's there. And so I think, there's a bunch of factors driving that, and you'll see that they come through right across the risks when you read the report. I'm not going to go through all of them today. But you'll see that they intermix and they mingle as you sort of go on. So, number one is those supplier gaps that we're going to have in the future, in terms of what's there. So to meet copper demand for 2050, we need 40 new Quellavecchios. So Quellavecchio cost us over $10 billion to develop and took 20 years to get approval in terms of what's there. We won't talk about copper mines that have got over 30 years since they were found and still haven't been developed, but over 20 years to develop it. If we don't get on to doing that quickly, 2050 is not going to get met in terms of commitments. Not just by mining companies meeting their net zero commitments, countries won't meet them because they won't be able to get renewable energy out. We're seeing continuing issues with traditional capital. And we've seen this trend over the past couple of years. Capital has become socialised. So capital used to flow depending on what wealthy families wanted to do. So think back to the Standard Oil days and those sort of things. It was names like Rothschilds, names like Vanderbilt. They decided where capital went. These days, it's pension funds and sovereign wealth funds. And they are very, very different in the way they think about capital allocation. Our pension funds in Australia are largely workforce-based, and there's a unionist pretty much on every single board, and there's a former Labor Premier on most of them as well, in terms of what's there. They're not right-wing anymore. Then capital doesn't look like that anymore. It's really changing the way things are allocated. It's not just the Canadian Teachers Fund saying they don't want to invest in capital. It's all funds in terms of what's there. We've got to meet expectations or they won't invest. And the final one is sustainability. If we don't operate well, if we don't reach those goals that we have, we're not going to be there. And I think the Nature Positive initiative this year of the ICMM was a fantastic one. I hate the word net zero. Anyone who aims for zero fails. When does an achieving person say, I want to get to zero? That's not what you do. If you want to kick a goal, you need to be positive in terms of what's there. And I think that Nature Positive initiative is a fantastic one to bring up the thing. We're going to leave it better than we found it before. We're going to make a positive contribution to the economy, to the environment, to the workforce, to the people and the stakeholders that are around us. I think that's a fantastic initiative. Okay, so let's have a look at our risks. So, excuse the colour scheme. I'm sure they'll come up really well on a webcast. Number one this year is capital, in terms of what's there. It's one of those issues that's perennially on there, but it hasn't been number one for a number of years in terms of what's there. And I think, we'll certainly focus the first couple of questions on that when we have the panel up here. I don't think that's a surprise to people in terms of what's there. We need capital to meet the opportunities that are ahead of us. But this one is really about those opportunities and how we take hold of them. We have a couple of new ones this year. Reserve resource depletion. So a number of mines are getting to their end of life, or they're getting far more complex than they ever have been, and we need to replace them. As I said, we need 40 new Quellavecchios. But we need new iron ore mines, we need new metallurgical coal mines, we need battery minerals to be economic so that people will develop those opportunities and do something with the resources that we know we've got. We've got heaps of them here. We've got to get ahead of that in terms of what we're doing. New projects is also there. The cost of building a mine these days is incredible in terms of what's there. Exploration costs have gone up tenfold in the last 13 years. Development costs, I wouldn't like to see the number. If exploration costs have gone up tenfold, development costs have gone up more. We're not just competing with ourselves for those developments in terms of what's there. So 2 new ones that I think will be really interesting in terms of what we're doing. We had ESG at the top last year. That really changed this year and became environmental stewardship, and I think that is a reflection of the nature positive piece in terms of what's there and people realising what they've got to do and that being top of mind in terms of what's there. I think there's some great progress being made there. You know, I think the COP meeting this year in Azerbaijan is going to be one to miss, that's for sure. But the year after we're in Brazil, and the mining industry is going to make, you know, Vale is going to be a key sponsor, and I think that's going to be a fantastic meeting for the mining industry to show the world what mining's role will be, not just in energy transition, but in healing the planet and making sure that we've all got a good lifestyle as we move on. So I think it was really interesting that one came through. The surprise for me this year was that workforce fell off. So as Mike said, I'm on the board at Colorado School of Mines. Yeah, the number of people coming through and doing mining engineering degrees is scary. #1 mining school in the world has less than 100 undergraduate students. We just do not have enough mining engineers. If we need 40 new copper mines, we need more than 100 mining engineers to run those things in terms of what's there. So I was shocked that that one came off. But I think it is reflected in some of the other issues in terms of what's there. So I think we will get a little glimpse of it, and I'm sure our panellists will have something to say in terms of what's there. Okay, I'm going to just go through a couple of them. As I said, I'm not going to do them all. I'm just going to do a couple of risks. But I did want to say something about capital before we sort of went too on. I probably don't want to make sure I steal any of the thunder of the guests. I think, you know, the need for accelerated growth is common right across everyone we did. And I think if we did a little survey in this room, you know, what should capital be applied to at the moment? We'd all say growth of our businesses and increasing our capacity. For the last 10 years, capital strategies at big major mining companies have focused on return. Yeah, so BHP was the largest dividend payer in the world last year, and they've focused on buy. I think, you know, the bid for Anglo American, the split up of Vale-based minerals, this means that that's going to continue this year in terms of what's there. There's a third strategy for capital, and that's build. And we need to flick to it. We need to somehow work out, how do we encourage mining companies to build more new mines? And that, you know, at one level you'd say, well, you know, you've just told us that, you know, future demand looks good. Shouldn't that be positive? Iron ore price is $115 today. What are you all waiting for? It's not as simple as that. And we'll talk about it in the new projects, but getting approvals is just ludicrous at the moment for a project in terms of what's there. Brownfields projects. You know, there's one in Chile that, you know, is run by one of the companies that's named up there. They own a mine on one side of a ridge. There's a ridge in between, and they want to develop a little bit brownfields that's in between the two mines. There's nothing else there. 5 years in, they cannot get approval to extend the mine to that little bit. You know, the most logical thing in the world would be to do a joint venture, bring those mines together, mine the whole lot. Why won't it happen? Because approvals are so complex to get these things done. And that's just crazy in terms of what's there. So we've got to work out, how do we flick the switch to build in terms of what's there? If it's not part of the equation, we're going to really struggle. And we've got to work out ways to incentivise capital allocation to those things that the market, the traditional market, will wait for. So how do we make sure that when the nickel price is depressed as it is, that we continue to explore for it. Okay, the mines might be shut, it might be tough to operate them, but we're going to need more. How do we encourage exploration and innovation in lithium? How do we make sure that we get rid of some of those technical issues that mean those big dams that operate in South America don't do huge environmental damage in terms of what's there? And getting those things right is going to be really critical to the energy transition and the brand of our industry. But with the price the way it is at the moment, that's not going to happen. No one's going to do innovation in lithium at the moment with the price where it is. But we desperately need it in terms of where we are. So I think, we'll certainly ask the panel what they think about the switch and where they think capital is being allocated at the moment. Environmental stewardship, as I said, really came out much, much stronger than the S and the G. So the S is still on there, I think, in terms of licence to operate, although I do think licence to operate has broadened. So I think in the past couple of years, when most people have answered licence to operate, they've thought about Indigenous questions and those sort of things. I think this year, when you dig under it, licence to operate is about keeping the right to operate. So it's worried about nationalisation of resources. It's worried about being able to export your product. And it's worried about being forced into do beneficiation that you can't afford in terms of what's there. And I think licence to operate is going to start to become, how do I have the right to operate a successful, thriving business that happens to be underpinned by mining? I think that's what we're going to see it become about. Environment, as I said, has become about nature, and I think the initiative of ICMM is fantastic, and I think it's also great to see all the other mining bodies picking that up and companies that aren't members of the ICMM adopting that standard as well. And that was always the hope when the ICMM was formed, that it wasn't just going to be 20 companies that did things, that it was going to be everyone. And I think this nature positive issue is one that's certainly driving that in terms of what we're doing. First of our new ones, reserve and resource depletion. As I said, the traditional mines that we've operated for the last 50 years, many of them are coming to their end of life. Mine closure has become a reality in terms of what we're doing. Mine replacement is something that we've got to do. So links in really tight with that switch to build. Resource and reserve replacement doesn't just depend on exploration, it depends on build in terms of what's there. And I think that critical message needs to get out there in terms of what's there. As I said before, we've seen the costs increase significantly to do that. I think we have to work out what are the ways to get that under control. That's going to be one of the big challenges we're going to face. As you can see there, the cost of exploring copper went up almost 10 times in 10 years. Now, yes, that means that we're operating in some complex environments. Yes, that means it's more expensive. But it is just those costs that just become sticky in our industry. It's about people, it's about energy costs and those sort of things. Running energy for an exploration project is incredibly complex. Drillers will tell you that they need to link in with their mining and their operator. And when people are out remotely, finding enough energy to be able to do the right exploration is really tough. And so working out how we solve those problems will be what gets that price down. I think one of the good things we have seen is that we have started to see a switch in where exploration expenditure is going to go to. So that one of the other bits that really shocked me with the survey was the vast majority of budgets for exploration have gone to gold. Now, last year, thankfully not the same, but the year before, 70% of exploration budgets went to gold. And that has started to switch and we've started to see rises. So big increases in copper, and thankfully we haven't seen drop-offs in lithium and nickel, and I think that's going to be really critical. Okay, that was all I wanted to go through. I'm going to invite the panel to join me up here and we'll go through some questions. Thank you. Okay, thanks everyone. So, I can be untraditional as it seems these days, and I'm going to start with my first question to Simon. Simon, I think, as I've mentioned to you before, every time I talk to Peter Cunningham and I show him through the risk list, he asks me why capital is at number one. So I'm very pleased to see that it's up there this year. I can feel him saying it's about time. Capital's obviously increased pretty significantly in cost. How do you think that's been impacting the sector in the last year, and then how do you think it will going forward?
Yeah, okay. Look, certainly not surprised to see it at number one at the moment. Everybody is staring at rising costs, falling prices. We've got a margin squeeze, and we've all got shareholders banging on the door that says, I'd like a dividend. And that's a difficult balance. I think if you go back, last 50 years, the mining industry has been characterised by I married a world-class ore body with a whopping amount of capital. To do that, I needed to be certain of risk, I needed to be certain of the future. Most of these are 50-year investments, stable policy frameworks, etc. You sort of roll forward to where we are now. When I read the capital, it's sort of intermingled in most of the other risks. It's really growth. What you're sort of saying there is, I'm struggling to grow. My costs are going up, my productivity is going up, my time frames are blowing out. And as an investor, that looks risky to me, and therefore why should I give you some money? That's somewhat incongruent, as you say, with the longer term picture, which is the world needs resources. The world wants mining, the world needs mining, not sure it wants mining, right? And making sure that we get that balance right is certainly a difficult one. And then I guess the third dimension of that is you stare at the health of your own balance sheet. There will be winners and losers in this game. In one side, yes, capital is a problem. On another side, if I have a healthy balance sheet and a lot of cash flow, I also see it as quite an opportunity as well. So there's probably two sides to that coin. Notwithstanding that, things are getting harder to build. It's struggling to keep up. What I will say is we've gone into quite a large iron ore venture in West Africa with our Chinese joint venture partners. They build things differently to us, and there's some things that we can certainly take away and learn from that. We've got to go a few hundred kilometres with a rail line, and as luck would have you, you've got to cross a lot of bridges and so on and so forth. We at Rio would typically design every bridge perfectly. They have three sizes of bridge, really long, and short. And you only get to choose one of those three bridges. And let's say the gorge is a kilometre. Well, that says you're using a very large big bridge, which is now 1.6 k's. Bad luck. You get the big bridge. You're not allowed to redesign. You are just using everything from a modular dimension. And some of that, I think we're going to have to adapt the ways that we look at building things as well, because with capital intensities where they are, prices going where they are, the requirements, something in this has to give.
Yeah, I lived in China when the metro system got built, and Line 8 got built in a month. The Sydney to Sydenham train line is currently closed for 18 months while they extend the metro for 5 kilometres. Yes. Sandy, ESG dropped as number one risk this year, but I feel it's probably even in capital in terms of what's there. Are you feeling more pressure around ESG measures and those sort of things in terms of capital and just influence from there?
Yeah, look, I think ESG has irrevocably changed the way we interact with our investors. It's now part of the mainstream engagement processes we have. So if you think about the way we talk to investors, it's an ongoing conversation, right? So we're meeting with them on a routine basis, there's regular reporting. And I think what you'd say is it's moved from being kind of tangential to engagement to very much in the mainstream and a core expectation. I think that's sticky. I don't see that changing. I think what you'd also say in relation to capital is it's affecting the way funds are flowing globally. So you touched earlier on some of the coal elements, and certainly you'd say if you think about debt capital markets, you've certainly seen less bank financing in going into kind of fossil fuel companies, and certainly seeing less of their participation in revolving credit facilities for coal entities or predominantly coal entities. Equity capital market, I think we've seen that kind of transition of the demergers and the sale of coal assets in particular. We also see BHP Petroleum exiting out of petroleum. And so I think you are seeing this kind of equity capital market transformation in parallel. I think there's a lot more to play out there though, and an interesting transaction this last year has been the Glencore acquisition of Teck's coal assets and the subsequent recommendation from their shareholders, by 95% of them, to retain the coal assets. So I think there's some really interesting mechanics playing out in capital markets. The last point I'd say is to the discussion on some of the capital points. I think that, and I think you touched on this as well earlier, is the fact that the bar has absolutely shifted. Whether you're raising debt capital or you're raising equity capital, there is absolutely a requirement to be ESG credentialed, and it is in the best interest of our industry for that to be the case. Absolutely, hands down, we want this type of disclosure, transparency, commitment, delivery to targets. It's definitely in our best interest as an industry. So I think we don't shy away from it. I think we commit to it and we double down into it. I think that's the best strategy we've got.
Thank you. What do you think needs to be done to get CFOs to switch to build?
Do you know, one of the things I was reflecting on as Simon was talking was the fact that, I'll come back to that question, was the fact that investors have a very different time horizon to organisations, and in fact where our industry is at. And I think that's one of the big factors when we think about the challenges in making capital allocation decisions, is we're thinking about things for decades. A lot of our investors are thinking about things on the quarter. Yep. And when you think about the metrics they're being held to, what was my divvy this quarter? What was my buyback rate of return? How much capital was put back to me, the owner, versus how much are you investing in the future that I may or may not ever get a benefit from? And so I think there's this very challenging dimension of time horizon, and we've certainly seen that and experienced that in decisions we've taken as an organisation in the last 12 months. More generally, how do you convince CFOs to allocate capital differently? I guess I view it, you've got to be balanced. You've got to be consistent and you've got to be balanced. And I think markets will accept that if there is a consistency and an understanding of the way in which you're intending to deploy capital, they will enter or exit out of your register basis their preferences on your commodities. But I think the bigger challenge is to really try and get comfortable with the fact that sometimes decisions we take for the long term are at odds with the quarterly outcome for investors.
Absolutely. Yeah, I think some having things like pension funds that are longer term investment and sovereign wealth funds, it has slightly shifted us away from the quarter by quarter, but it's absolutely still there.
I think that's right. I think the one thing I'd say is there is an element, analysts influence markets enormously. They are quarter by quarter led, and they themselves grade against how they performed in estimating where people were going to land. Yeah. And so I think that has an outsized influence on the market, but I think you're right. Long only, long hold investors, incredibly important to those long-term strategic decisions.
Yeah. Simon, Sandy mentioned Teck disposing of their coal assets and Glencore picking those up. We've seen a range of portfolio changes. Do you think there's more of that to come, or some changes in that to come? What do you think is coming next?
Yeah, I think reports said something like 76% of people saw. Tell you what, if there's any bankers in the room, you're all going to get rich, and I presume EY as well. On the number of due diligence reports, you'll be licking your lips. Whether any of that actually comes off, let's see where we go. I mean, the obvious answer is everybody wants the same things. Do I want more copper? Yeah. Do I want more lithium? Yep, thanks. Well, that's a relative, the first order to that question is pretty easy. The problem is you're looking at copper running at 13 times, and how do you stick that inside a diversified at sort of trading at 5 times? That's a problem. Where you're seeing divergences in those multiples, on one side, okay, the future-facing materials, yes, great story. Certainly if you're a smaller cap trying to raise money, wonderful, but difficult to go after it. The flip side of the other end is coal. If you can wear, and these are for individuals to make their own determinations, if you're comfortable to wear the ESG implications of owning coal, you're picking it up at 2-3 times. Okay, the return on capital and the payback there is relatively attractive, so they're being remunerated as well. Then you've got the big diversifieds who are sort of stuck in the middle, where are you future facing or are you still holding on to iron ore, aluminium, etc.? I think there's a role in all of them. I'm biased in one respect, which is I think the only strategy to navigate through this is to have as much operational cash flow as you can to give you those options. We very much take a very similar lens on the ESG. We are not going into fossil fuels. That's a determination the company's made, and we are closer into the space of building. If you look through our portfolio, we've just finished a large investment in Mongolia. The next very key investment we want is a large copper mine in the United States, but once again being held up in permitting. So we're probably in a space of moving the portfolio closer to future-facing materials with a buy lens, but in the event that we get a shock in the market, yeah, we would like to have the firepower ready to react. Typically, though, we all know the metric is that 90% of M&A burns money, and certainly in those commodities where everybody's going to be hot in them, it's a seller's market.
Yeah, I think every portfolio review I've done, they all come up with the same answer. It's a bit of a worry. There's not that there, but
it does make growth illusionary, though.
Absolutely.
And that's challenging. So, gold, that's certainly a question mark. One of the areas we've started looking at is what are the other areas of the value chain that we historically haven't really pushed into. We recently did a transaction in North America, a company called Metalco, which has effectively, it's about doubling the size of our aluminium book from a recycled product. They also in that transaction is some downstream processing facilities. It gives us an unrivaled product offering of green aluminium as we seek to sell into that sort of European auto sector. Equally, we all know in the mining industries we like to own our own toys. From the trucks to the ports has to be ours. I think he's just staring at the desire to move towards green energy, wind, solar, etc. There is probably elements of our infrastructure which we never would have conceived not having solely owned on our balance sheet, but entering into longer term relationships, and we've recently signed one with the Injibandi, and how you find a way to create an opportunity in some of those different elements of your supply chain that we probably haven't historically worked our way into before.
We might move on to our new risks, so resource reserve depletion and projects. Adrienne, we'll get to it. I know you've had some experience with government and certainly in terms of policy. What should governments be doing to reduce red tape, reduce this permitting time, average of 15 years globally? We're probably a little bit longer than that in terms of what's there, and encourage investment.
Thank you. Yeah, I think this is such an important risk, and one that we probably hear the most about from CME's members. We represent mining and oil and gas companies in Western Australia, and this will be number one issue on our members' radar. It's really interesting that I was listening very closely to your comments about the opportunities around the nature positive agenda, and I think some of our anxiety at the moment, and again, this is probably coming from a domestic Australian policy perspective, but it's how that manifests that absolutely supported ideal of being nature positive, and that being such an important conversation, and ICMM doing excellent work in that space. I guess the worry is how that manifests from a regulatory perspective on the ground here, and what we've sort of seen so far as regulators have grappled with that question is that those dual objectives of better for business and better for the environment on paper are a little bit more challenging than anticipated, and something I think that as we work to bring more mines to market to meet that those global needs for not just the critical minerals, the ones on that special list, but for the building blocks of so many things that are going to be needed for the transition. We really need to make sure that those regulatory reforms are appropriate and allow us to play the role that we need to play in that process. And I think a key thing that stands out there, and I do see some of this conversation starting to happen in other jurisdictions, the US stands out around accountability around timeframes. So we hear a lot from members, whether it's 5 years or 10 years, we need to know that up front. And understand what that process looks like end to end and how much time we can expect to spend. And unfortunately, that continues to be elusive. And so one of the things we've been working closely on, both at a state, local level in WA, with the WA government's response to what we call the Vogel-McFerrin Review, and they've made a pretty significant commitment to implement 39 of the whatever recommendations, which has been fantastic. But unfortunately, what's happening federally with this shift towards a nature positive agenda is taking us almost in an opposite kind of direction. And I think, yeah, again, the key word is accountability and having clear KPIs and processes within approvals agencies that are reflective of business expectations around timelines, and some clear reporting, upfront understanding and accountability around that.
Great.
We're actually in that process that you referred to. So Fast 41, it's a permitting process out of the US. It was introduced under the Obama administration. And we were brought, our project, the Taylor project, was brought into that as the first mining project. And I think to Adrienne's point, it doesn't bypass any steps, right? You're still going through every single critical step to ensure that ultimately the project you deliver on meets the expectations for environment, for community, and for economic benefit. But it has a defined schedule that is published and agreed, and it has someone we refer to as like the permitting czar, who decides when there is regulatory inconsistency or we're not sure who has the approval right, they will decide who has that right. And so you don't get caught up in the bureaucracy of separate business units or business interests within government. And so it's been an incredibly powerful tool. I do think it's a bit of a shining light for the globe, and certainly something other governments could look at as an example of what to do.
Yeah. Hopefully it'll survive an election.
I would hope so. Came in under Obama though, so it survived a while.
Okay,
Yeah.
fair enough. Sandy, the cost of exploration really surprised me in terms of what's there. And I think, if you look at innovation over the past couple of years, electric vehicles, autonomous vehicles, doing those sort of things, we haven't seen a lot in exploration in terms of what's there. Are you seeing anything in terms of where you're looking and seeing anything different happening in that space?
Yeah, so I mean, exploration, critical part of the life cycle. I'm sure everyone here thinks that probably the biggest value lever for shareholders. So delivering value through the drill bit, probably everyone would say is the best value case. You talk about build versus buy. There's also discover. And I think everyone would say that that's got an enormous role to play. I think capital has been deployed inconsistently to exploration. I think you touched on that as well. We don't see that it sustains the down cycle. So when margins get compressed, discretionary costs are going to get pulled out of the business. Exploration will absolutely be on that list. I think as a result of that, you don't get the sustained programs that drive innovation. And that's a really big challenge. It's a challenge that organisations have to go through. We try to keep a minimum interest and to maintain those programs, but for sure, our capital allocation, like every other part of the value stream, will be squeezed. And so I think it's probably a part of the value stream that's been under that type of pressure. It's also very long dated. Yep. It's beyond the permitting horizon, right? So you've got to have people committed to looking out to not the next executive team, not the one after, maybe the one after that. Right? And so this is very long dated NPV, and it's going to compete for much higher order of issue capital allocation. So it's going to be, am I going to do safe and reliable capital to make sure that my business is safe for all my employees and I'm doing the right thing by the environment, or am I going to spend $20 million on an exploration, drill a few holes? Yep. That's a really hard decision to take.
Yeah, absolutely. I think, you touched on collaboration. I think, the collaboration between Rio and BHP, Komatsu and CAT around autonomous vehicles has been fantastic. A long time coming, but just an incredible initiative. I think, you guys deserve praise for that one for sure.
Yeah, I was quite heavily involved in that one. I think the most refreshing thing is both of us got to a conclusion that it's our moral obligation to find a solution for the industry. And neither of us saw it as a competitive advantage. So the idea of doing it both between the two of us and the two major OEMs to get a coordinated pathway into this, was really pleasing to see.
Yeah, absolutely. Simon, you talked about Simandou before, and I guess, there's a couple of projects going on. Where are you seeing competition for resources in terms of new projects? Is it other mining companies, or is it the energy transition? And just, how tough is it out there to find civil engineers and find earth movers and do those sort of things?
Yeah, I'll deal with WA and then I'd say there's an answer for WA and there's an answer for the rest of the world. It's probably quite location specific. It's interesting that that sort of access to labour wasn't on your top 10. I saw that as quite a strange thing. Look, at its core, yeah, certainly things here have softened in WA, and everybody's read the newspaper about Nickel West and depressed prices and so on and so forth. That's sort of helped. It doesn't automatically flow through to those 20,000 people now want to turn up at my front doorstep and say, I'd love to move to the Pilbara. That's probably the bigger challenge, is the increasing desire of people to A, want to participate in mining, and B, to want to live in pretty remote locations or fly in, fly out. Those base skills and base talent attraction is where we are struggling, and the competition's with the miners, not so much the energy transition. The top end of the scale, the bespoke, Sparkies and a range of the sort of the technical disciplines, that's probably come off a bit. It's the base skills of people wanting to enter the mining industry that is the fundamental challenge that we face at the moment.
Yeah, absolutely. We might move on to ESG. So as I said, environment came out top this time rather than climate change or sort of some of the traditional ones that we feel. Adrienne, mining companies are often questioned about their environmental impact and what they're sort of doing with communities and what the impact is. What else can the sector do to sort of communicate what it's doing to address some of these concerns? Is there more we could be doing? Are there things that we should be pushing on?
Thanks. Yeah, look, I think Sandy already well covered the amount of transparency that's occurring in the ESG space, which I completely agree is very important. I think one of the areas of focus is how we actually communicate that locally on the ground. So I will go back on my nature positive bandwagon in a minute, but I suppose how are we tackling that? I mean, one of the things that CME is doing as the industry body is actually collecting postcode level data so that we can track how that spend is contributing locally to not just jobs, but to local businesses and community groups. We look to build on that every year, and every year we see those numbers grow, and they're really significant. And that's one of the things that we work to try and get out to really, make sure that local members of parliament understand what the workforce demographic in their electorates look like, and how that translates locally to flow on to small medium business, for example. So yeah, that's absolutely important part of maintaining that license to operate that you spoke about at the start. Other piece around environment, same expectations, and just looking at, often the approach to regulate in this space comes down federally or more globally to some extent, but the imperative is to demonstrate to the local community that those environmental objectives and commitments are being delivered on. And so when you look at establishing something like an environmental offsets fund, for example, there's a need to make sure that there's really clear governance around that so that companies do still have the ability to show how, if they ended up having to pay into the fund to cover an offset liability, that actually translated to a tangible environmental gain on the ground where they operate in those communities. And I think there's a story maybe to continue to tell around what we're doing around different approaches to rehabilitation and the contribution to science that's being made by the experts that work within, the really passionate people that work within the sector who are out there doing the biodiversity surveys and actually discovering new species quite often and contributing to that data set. And I think there's more that can be done to centralise and improve the use of that intelligence, a lot of which is coming from the sector as well. So I think ESG continues to be something that the sector can be really proud of, and there's a continued need to do that both kind of at a global level from a shareholder perspective and also locally on the ground with those communities.
Okay, thank you. Simon, I think, one of the other things that really interested me in the report or in the survey, 30% of people said they weren't sure they'd meet their climate change commitment, so net zero.
Only 30?
Yeah.
Excellent.
Now we didn't dig in and say, was that your 2030 target or was that your 2050 target? We left that pretty open on purpose. Headlines are always good in terms of where you get it. What are the challenges in getting to net zero?
Well, How long do we have? Probably stick it in 3 buckets. So let's go with the easier to abate sectors. So for us, obviously, we need a huge amount of power to run our operations, so typically funded through gas. Pathway to replacement and improve our emissions from that is really sort of solar, wind. It's back to approvals, right? So delays in approvals, delays in transmission frameworks, delays in sort of any of those other sort of regulatory challenges. There is a desire and there is capital that can be prosecuted against those projects. The speed of that is what is at risk in terms of the near-term timeline. Then there's probably some medium stuff that sort of sits in the portfolio. Heat exchange in the aluminium facilities, what we're looking at through that, diesel electric trucks. You can probably see a pathway that's there. Not all of the technology is in place at the moment, but can you conceptually grasp where battery electric trucks are going? Do I bring the charge to the truck? Do I bring the truck to the charge? Do I put dynamic charging in? There is enough smart people in the world and enough capital being allocated to that problem that sort of says, will it happen exactly on the time frame and at the cost you expect? Probably not. Will it ultimately happen? Yeah, I can see a pathway. And then you end up in the 3rd bucket, which is the exceptionally difficult to abate, and that's obviously steel. The majority of the world's iron ore obviously is, the majority of the world's steel is made through blast furnaces. How we work our way through that particular problem, I mean, there's a couple of elements. One is you can switch your iron ores, okay, and we can look through the ultra high grade iron ores, certainly those that we have in the portfolio of Canada, and we access the sort of the EAF and DRI route. Okay, tick. Here's the core challenge. There's 900 million tonnes of 1.6 billion tonnes that comes out of the Pilbara. The world has to find a solution for finding a pathway for Pilbara ores to go into green steel. We've announced 3 effectively irons in the fire. We have a bio-iron facility that we are developing here. There's a partnership once again with BHP and BlueScope around electric melter. And there's a range of other joint ventures and agreements that we have with our customers. It's one that we are all jointly incentivised to solve. Do we have a defined technical solution to it? No. Are we all committed to investing in it? Yes, we'll have to put a number of irons in the fire. What I will say is by emissions and the desire to abate the sector, the inroads you're seeing in existing blast furnaces are far greater than we had actually anticipated before. A number of our Chinese customers are talking about 30% reductions in their existing facilities without having to reline furnaces, etc. So really when you think through age of blast furnaces, what you can take out in terms of productivity, and then you add some new technology, there will be a solution in that somewhere, but that is far longer dated than, I guess, the first 2 in the category.
Great, thank you. Sandy, I think mine closure was this distant thing when I started in the industry, but it seems to be a reality now. I mean, there's discussion on a number of mines that have closed in this state and around Australia. It's a legacy issue we've got to fix in terms of how we're going to do it. What do you see as the risks in mine closure, and how do we go about abating some of those?
Yeah, I mean, look, I think, first of all, yes, mine closure is a genuine challenge for industry, and for us in particular, we have 2 mines that are probably set to close around the turn of the decade. So then this decade we'll have 2 closing. And I think the way we think about this first is, what is the legacy we're going to leave behind here? And of course we want that to be a positive legacy. And then in one of our mines, there's a very different contextual backdrop, and that then talks to what is just closure. And I think they're very different in the way that we'll have to think through the risks and opportunities. So to give a little bit of colour, one is our Cannington mine, and it's a FIFO operation. So it's quite remote, there's very limited community interaction. So it really is a very traditional kind of manage the risks of the rehab, do closure really well, net positive outcome as the intention, right? And so that's really quite straightforward. Where it's much more, where there needs to be a lot more thought and consideration is on our Groot Island operation, which again is set to close around the end of the decade. we're operating in a community with a significant interaction with traditional owners. We run facilities on the island. We provide services to traditional owners on this island. There's a lot of infrastructure there that will likely be beneficial and important to their ongoing future on island. And so I think that's one that requires an awful amount of listening and engagement and consideration of those factors of what is it they're looking for, what is possible for us to do. And so I think it's very contextual for closure, and we've got those obviously two very clear examples in our business. We're seeing it really differently.
Thank you. Conscious of time, so I might move to some global questions, and we'll do them reasonably quickly, so we can give a chance. We're not going to get time for questions at the end, but we will get some final comments. Adrienne, we've seen the IRA obviously in full flight, the EU Carbon Reduction Act, and those sort of things. Maybe a local question for you, but based on those global things, how does WA and how does Australia compete? What are the things we have to do to compete with some of those incentives that are being offered there?
Yeah, another really important one. And we've seen also at a federal level sort of an attempt to create some industry policy and take an industry policy approach, which in and of itself is a really interesting question and exercise. I think we're a little bit early in our journey around discovering what industry policy works and is going to work for Australia. I suppose we don't think of the things like the Inflation Reduction Act, although it has had an incredible draw on capital, as necessarily being in conflict with what we're trying to achieve here. I think there's also a lot of well, it depends on what you think we're trying to achieve, I suppose, but it also held a lot of opportunity for upstream projects in Western Australia to be able to be part of that supply chain into the US market. And the European market, no different. I think we need to get really tactical about how we look at those incentives in those other jurisdictions and what the specific opportunities are for the resource sector here in Australia and how we can specifically play into those by being very nuanced in our approach and tactical in looking at those strategic drivers for some of those initiatives elsewhere. I think that in terms of what it's going to take to be competitive overall, we do know that we're a high-cost jurisdiction, so we have to be so disciplined in keeping downward pressure on those costs. And I know you talked about margins and increased costs. We're definitely observing that across the board as well. I think you mentioned energy. We've seen about 50% increase in wholesale energy prices just over the last couple of years, so taking up a much more significant component of that overall cost curve. And we need to address the approvals backlog that we've already been speaking to, but it's going to take a range of measures. The approach that the Australian government's pursuing with a tax incentive, nowhere near what the US government has on offer, but it's our approach, and I think we've got to a point where we can't not respond with our own brand of industry policy. We have to rise to the challenge and seek to play into those opportunities.
Great. Yeah, I think, one of the advantages of WA being critical to the federal election next year, I think, is a bit of lobbying on play to our strengths. Will go down very well. We don't need battery factories. We need to mine the stuff first. You can build your battery factories next decade. Let's focus on the stuff we need now.
100%.
Sandy, you mentioned before you've got experience with US incentives in terms of what's there. I'm glad I'm not doing this one. I did this in Colorado last week, and of course the first question I got is, what will Trump change? So I'm not going to ask you that. I guess any lessons you'd share in terms of accessing these incentives and what we should be doing here in WA to be competitive?
Yeah, look, in terms of accessing the incentives, these incentives are put in place by governments that are trying to stimulate a particular activity, right? And they want to do so in a way that also then supports the economy and community. So they kind of got multiple aspirations sitting behind any one of their policies. The first thing I'd say to someone who's looking at that is how well do you fit with their intention? Generally, it's well signalled. Their politicians are talking about it a lot, right? So you can pretty quickly work out whether or not your project is going to deliver and into how many elements they want. It's kind of the first thing. I think the second piece to it is the quality of application absolutely matters, right? That's kind of a given, but it's worth saying because the more mature your project is, the better your project fundamentals are and your ability to execute on it well. I think that obviously plays into, again, their propensity to allocate capital or incentives to you. The last point I'd make is there's kind of an intangible piece to this, which is what is your corporate posture? What is your commitment to ESG? Do you follow through? What is your engagement like with other governments, other jurisdictions? Have you delivered? It's kind of all summarised under a have you delivered kind of a tagline, but it's against a really wide range of measures. And I think your engagement and your ability to articulate the way you've done that is paramount. It's the kind of third tranche of it, but it really matters.
And Simon, we've seen some good announcements from the Chinese government this week in terms of our industry, both incentives but also removing restrictions. I think that's the bit that the press hasn't picked up on. It's probably been more about some of the cities saying you can do different things in property investment. That's probably been the real driver. How do you see the outlook for the Chinese economy? And you can give us something on the iron ore price if you want, but Chinese economy was the question that we advertised.
I think I'll go with your line that if I was any good at forecasting the iron ore price, I'd be on a beach drinking cocktails somewhere. Look, we all know what the current challenge in China are pretty well documented. Consumer confidence, I was there a couple of weeks ago, it is flat. China certainly feels flat at the moment. Challenges with the real estate sector, well documented, and obviously provincial borrowing are all sort of hanging on that. At the same time, stimulus. I think everybody on the stage will certainly, I suspect your share price moved the same as ours did. So happy. Thank you for that. And a movement up in iron ore prices. How long it holds for? Look, question mark. I guess what we're starting to see is a bit of a shift in where the Chinese policymakers are going on the Chinese economy. I mean, let's be honest, it probably was, any growth was good growth. From let's say the 2000s to 2020, China was very much the manufacturing facility of the world. That's obviously slowed, and we're seeing softer growth, but certainly from a higher space. There's a number of elements still that probably get glossed over. I don't think the urbanisation story is completely finished yet. You're probably looking at a urban population of about 60-65% at the moment. There's still probably a little way to run on that. Still seeing a very high domestic saving rates, probably double what we're seeing in the West, which is certainly conducive for better growth there. I mean, the other thing that we think about, as you stare at the sort of the China issue, yes, we all got used to growth looking vertical, but it's almost sustaining the area under the curve. And you come back to this buy versus build. We don't, growth in steel, we're probably starting to see peak steel, but I certainly don't see it falling. And if you think about it through this lens, Pilbara is exporting 900 million tonnes of ore. To sustain that for a decade is going to cost you a lot more than what it costs to ramp it up. And a lot of that growth that you're seeing, let's just call it new, it's not growth in terms of aggregate terms, but in terms of total construction that's going on, just to maintain the volume of production we have here in Western Australia, and certainly in our own business, that is extremely capital intensive. And you're sort of seeing where iron ore prices go has to reflect a price that remunerates you and incentivises you to continue to deliver that capacity.
Yeah, thanks for that. I think it's a great answer. I think you're exactly right on the urbanisation not being finished. I mean, urban renewal will be huge as well. As I said, I was in, everyone thinks of Denver as a big city in the US. There are 100 cities in China that are bigger than Denver. And that, they were developed about 40 years ago. So they're going to be redeveloped soon in terms of what's there. So I think it's a great point in terms of what's there. Thank you all. Nice in-depth answers, so it always makes my job really easy. Any final thoughts in terms of the report? Things you liked, things you thought were missing, Adrienne?
Yeah, I mean, maybe one sort of more kind of global trend. I think the scale and pace of change generally, whether you're looking kind of at a micro level or domestically at regulatory changes, have been really significant, both at a state level for us and at a federal level. And I think globally, the energy transition and the investment required in that infrastructure and that kind of competition between the mines and raw materials and all of that is a really rapid change that I think we haven't experienced for some time, and it is going to both present opportunities and real challenges.
Absolutely. Thank you. Simon?
I think you probably could have put another 4 or 5 things on the list, and that probably reflects the sort of takeaway. It's getting extremely difficult, right? 10, 20 years ago, we probably could have got to 5 that we really honed in on.
Yep.
5 years ago, maybe we get to 6 or 7. Now you're down to, I need to take 15 and probably cut it back to 10, which illuminates the size of the challenge that's in front of it. I was sort of interested in where digital ultimately featured in some of these conversations, and it's probably that we're all so distracted on dealing with the day-to-day at the moment. It goes a little bit to timeframes and investments, but something in this mix has to change somewhere. Right, I've got costs going one way, I've got resource access challenges going another, I've got exploration going this way, I've got demand going this way. Somewhere in all of that, it probably doesn't fit. What is the circuit breaker that ultimately finds the pathway through it? I don't know if digital is the panacea to all of those, but I certainly think it's got an increasing role to play. Go back to your point on exploration. With the advancements in sort of computing power and where we're sort of headed, and I'm seeing my head of digital in the front row there, so he'll yell at me if I don't say something to this effect. But I mean, rethink the exploration problem. Why couldn't I I've got the computing power now to basically go back and reanalyse every single core sample that I have in my inventory since basically 1900. If you start thinking through what you can develop in computing powers and where that ultimately gives you an insight, which, let's be clear, at the rate it's going, insights that are possible today weren't possible 18 months ago, and that's doubled from where it was 18 months before that. So I do think there is a big opportunity in this space. It's not the only one, but that's probably my reflections.
Yeah, absolutely. So for the first time ever this year, we actually did include 15. So the last page of the report, you'll see what we've called under the radar. And digital.
Now you're exposing that I haven't read the whole thing, but that's okay.
It's the last page. We'll let you off there. So digital made number 11, and you're exactly right. Like if I look at what's increasing in budgets, it's spending on nature and it's spending on digital. They're the two areas that are going up, without a doubt. So yeah, it made it to number 11, and cyber was number 14 because all my cyber team just yell at me every time that doesn't make the list as well.
I've got one of those today.
Sandy?
Yeah, look, when I look at the report, I mean, the top 2 represent to me, first of all, shareholder capitalism, right? So the kind of traditional lens on capital allocation, and it's back in number 1, and it's not surprising, as we've all touched on with margin compression, inflation, commodity price depression, that made it to the top of the list. And for me, the second one represents that kind of stakeholder capitalism, right, which is continuing to it's an emerging theme. It's probably not even emerging anymore. It's really here to stay. I think it's number 2. It's probably nestled there for a long time or competing with number 1, pending how margins are looking. So I didn't probably see a lot of surprise there. The one that I think is a long-term issue that will come home to roost at various points is that workforce piece. And we saw the great resignation post-COVID. Almost all companies were competing for the same talent at sites. So you think your jumbo operators and things like that. And inexperience creates productivity issues, and it for sure affects safety outcomes. So I think there's a really big piece to play there on capability in the workforce. Reflecting and stepping back more generally as an industry, I mean, love China's announcement, but also love that we're back in an easing cycle, right? So the Fed's back, thank you very much for 50 basis points. I was calling for 25, but I loved the 50. And I think that's really impactful, right? Because it gives that stimulus back. It's putting back into the globe this kind of sense of momentum. And I think China added into that, of course. So from and then obviously this longer narrative backdrop of energy transition, mining being done well, good for the globe, right? And I think there's this real opportunity for us to play in that space now. So for me, never a better time to be in mining.
Couldn't agree more. Mike, back to you.
Thanks, Paul, and just join me in thanking the panel for That wasn't me. For joining the, thanking the panel for the, I guess the insights that they've given in the open way in which they answered the questions. So thank you. Simon, perhaps thank you for your insights on capital. And I'm not sure if Paul put you up to the digital, or maybe Mark Cotter in the room here put you up to the digital comment, but thank you for bringing that up. It wouldn't be, Adrienne, it wouldn't be a discussion on business risk in mining in Western Australia if we didn't talk about permitting. So please keep up the good work. I really like the accountability timelines and framework. So if we can get there, that would be great. And Sandy, thank you for everything that you contributed to the conversation and sharing the insight from your story there in the US and how you got things done faster. So thank you. For those of you online, would love to hear your feedback, either on the webpage that you've got access to or on our LinkedIn. I would appreciate that, and thank you.